Nvidia added $277 billion in market cap in a single day. That is the entire economy of Portugal, appearing overnight, out of thin air. And the company that made that happen? It mostly sells chips, little rectangles of silicon, to companies that are, by and large, still losing money. That is not a flex. That is a warning sign wearing a party hat. Let us set the scene. It is 2024. AI is no longer a buzzword. It is a religion. Every earnings call, every pitch deck, every LinkedIn post from a guy who read one blog article. All of them are dripping in the same holy water. Artificial intelligence. Two words that can add $1 billion to a stock price before lunch. CEOs who, 12 months ago, had never touched a GPU are now telling investors their company is AI native, whatever that means. Nobody really knows, but it sounds incredible. Sound familiar? It should, because we have been here before. Different decade, different technology, same delusion, same ending. We are talking about the dot-com bubble. And if you were not alive for it, or you were but you blocked out the trauma, let me explain what happened. And more importantly, let me explain why your portfolio might be about to experience a very unpleasant case of déjà vu. The 1990s. The internet arrived. And it was genuinely revolutionary. Let us be clear on that. Email, e-commerce, real-time information. Connecting humans across continents for the first time in history. The internet was not hype. The internet was real. But what happened around the internet? Now that is where things got weird. Companies with names like Pets.com, Webvan, and Cosmo.com were raising hundreds of millions of dollars, not because they had profits, not because they had a plan, but because they had a website address. The pitch was simple. Put .com in your name, get money. Worry about the business model later. Investors were not buying stocks. They were buying feelings. The feeling that they were in on the future. That they were not going to be the idiot who missed it. The Nasdaq went from roughly 1,000 in 1995 to 5,048 in March 2000. A 400% gain in 5 years. For an index full of companies burning cash like it was a competitive sport. What could possibly go wrong? Spoiler, everything. By October 2002, the Nasdaq had fallen 78% from its peak. $5 trillion in market value. Gone, evaporated, like it never existed. Because for most of these companies, it never really did. Pets.com burned through $300 million and lasted 268 days as a public company before shutting down. Their sock puppet mascot became the face of an entire generation's financial regret. But here's the part that makes the dot-com crash actually interesting and actually useful for us today. The internet was not wrong. Amazon survived. Google was born. The technology was real. The valuations were insane. Hold that thought. Fast forward to 2023. OpenAI drops ChatGPT. 50 million users in 2 months. Faster adoption than any consumer product in history. Faster than Netflix. Faster than Instagram. Faster than TikTok. And this time, unlike the dot-com era, the technology genuinely works. You can talk to it. Ask it to write your emails, debug your code, draft your legal contracts. It is not a slow-loading web page. It is not a pop-up ad pretending to be a service. It is real. And so the money started moving. Fast. $80 billion. That is how much was poured into AI startups in 2023 alone. Microsoft bet $13 billion on OpenAI. Amazon threw $4 billion at Anthropic. Google and Meta did not want to miss the party, so they essentially set their research budgets on fire and called it strategy. Nvidia? Do not even get started. Nvidia makes the GPUs that power AI training. Think of it like selling pickaxes during a gold rush. Their stock went from $150 in January 2023 to over $875 by mid-2024, a gain of nearly 500% in 18 months. Their market cap briefly touched $3 trillion, more than the entire economy of France. And the other companies? The ones actually building products on top of AI. Most of them are raising billions of dollars with no revenue, no competitive advantage, and a business plan that reads like a mood board. Here is where we need to get honest with each other. First, the valuation insanity. In 1999, Pets.com was valued at $290 million at its IPO. They had $619,000 in revenue, not profit, revenue. Today, AI startups routinely raise money at 50 times, 100 times, even 200 times their projected revenue. Not current revenue, projected. As in, the number a founder wrote in a slide deck while running on optimism and coffee. Second, the buzzword economy. In 1999, adding .com to your company name boosted your stock price by an average of 74%, according to a research study on Internet-era investing. 74% for a name change. In 2023, companies that rebranded to include AI in their name or announced an AI pivot saw nearly identical spikes. Not because of growth, not because of earnings, not because of actual users, just a word. Third, the infrastructure bet. This is where .com gets genuinely eerie. During the late 1990s, companies laid hundreds of thousands of miles of fiber optic cable to power the internet. Most of it sat dark and unused for years. Companies like Global Crossing and WorldCom went bankrupt, but that fiber eventually powered everything we use today. Right now, Microsoft, Google, Amazon, and Meta are collectively spending over $200 billion per year building AI data centers. The chips, the cooling systems, the electricity infrastructure. What if the AI winter comes and all that infrastructure sits idle? That is not a conspiracy theory. That is a question every serious investor is asking in private, while publicly smiling on television. Let us talk about what actually breaks a bubble. It is never one thing. It is always a pileup. For the .com crash, it was rising interest rates, a tightening Federal Reserve, and a moment when investors looked around and collectively realized that none of these companies actually made money. The Nasdaq started falling in March 2000, slowly at first, then fast, then catastrophically. Within months, venture capital dried up. Companies that had been raising $50 million could not raise $5 million. Layoffs rippled through Silicon Valley. Half the startups in San Francisco vanished before 2002. Now look at AI. The Federal Reserve kept interest rates high through 2023 and into 2024. Borrowing is expensive. Burning cash has a cost again. OpenAI, the crown jewel of the entire AI revolution, the company that started it all, reportedly lost $5 billion in 2024 on revenues of $3.7 billion. That means for every dollar they earned, they spent nearly $2. Anthropic, burning billions. Most frontier AI labs burning billions. The question investors are now asking, whispered at first and then louder, is the same question that triggered the .com crash. When does this actually make money? And there is no clean answer. Not yet. AI is being used everywhere. But most of the companies using it are cutting costs, not creating new revenue. AI is not generating new demand. It is mostly automating existing work, which is genuinely useful. But it does not justify trillion-dollar valuations on companies still figuring out their pricing model. The math does not work. When the .com bubble burst, it was not just hedge funds that lost money. Regular people, teachers, nurses, retirees had piled into tech stocks during the mania. Their retirement accounts got cut in half. Their retirement timelines got pushed back by a decade. Some never recovered. And the workers? Hundreds of thousands of tech jobs disappeared between 2000 and 2003. Entire cities went through economic whiplash. The new economy of the 1990s turned out to be a very old story. Hype, greed, collapse, cleanup. AI layoffs are already happening, not despite the AI boom, but because of it. Companies are using AI to automate jobs, then laying off the humans those jobs belonged to. Meanwhile, the AI companies themselves are running lean and burning investor money to stay alive. If the AI investment thesis cracks, if the money stops flowing because returns do not materialize, the downstream effects are enormous. Hundreds of billions in spending on data centers, thousands of startups with no viable exit, regular investors holding AI funds and AI-related stocks at peak valuations. We have seen this movie before. The runtime is different. The ending is usually the same. Here is what is different this time, and it matters. The companies leading the AI boom, Microsoft, Nvidia, Google, Amazon, are not pets.com. They are massive, profitable, cash-generating businesses with real products and real customers. Nvidia's revenue is real, $60 billion in their most recent fiscal year. Real numbers, real customers buying real chips for real use cases. The dot-com bubble was built largely on companies with no revenue, no users, and no plan. AI, at minimum, has working technology with genuine adoption, and the productivity gains are also real. Goldman Sachs estimates AI could add $7 trillion to global economic output over the next 10 years. That is not a small number. But here is the critical part. Real technology and rational valuation are two completely different things. The internet was real. The dot-com valuations were still insane. Both things were true at the same time. AI being transformative does not mean every AI startup deserves a $2 billion valuation. It does not mean this ends without pain. History does not repeat, but it rhymes. Loudly. In your ear. While you are trying to sleep. So what do you do with all of this? You do not panic sell everything and hide in cash. That is how you miss the recoveries, and every crash in history has had one. But you also do not confuse revolutionary technology with a reasonable investment. The internet survived the dot-com crash. Amazon survived. Google survived. But thousands of other companies did not. And neither did the savings of millions of people who bought the hype at the peak. AI will survive whatever correction comes. The technology is too useful, too embedded, too transformative to disappear. But your portfolio might not survive if you have confused AI is incredible with this stock price makes sense. Because in the end, the dot-com crash did not destroy the internet. It just destroyed everyone who forgot that even the future has to be paid for. The market can stay irrational longer than you can stay solvent, but it cannot stay irrational forever. Nothing can.